calm morning in Ottawa. Interest rates unchanged. The Canadian dollar moving within familiar ranges. On the surface, everything feels stable. Yet beneath that calm lies the Bank of Canada's deepest fear, not inflation alone, not a technical recession, but the moment confidence disappears. When people begin to doubt the value of the currency in their hands. When investors quietly demand higher CDS premiums for Canadian risk. When liquidity becomes a more urgent question than growth. History shows that major crises rarely begin with explosions. They begin with long silences. A housing market slowing, but not collapsing. A banking system still functioning, yet increasingly reliant on short-term funding. An economy where real incomes fail to keep pace with the cost of living. The central bank understands this well. The most frightening moment is not high inflation, but when policy tools lose their power. When raising rates no longer cools demand, cutting rates threatens the currency, and every decision carries systemic risk. That is when true fear begins. The signs of crisis rarely arrive as breaking headlines. For the Bank of Canada, they appear quietly in data curves that seem harmless at first glance. A yield curve flattening, then inverting, signaling weakening growth expectations. Household debt-to-income ratios remain elevated, while real interest rates are no longer negative as they were after COVID. The housing market, Canada's cornerstone of personal wealth, begins to fragment. Prices stall, transaction volumes fall, and selling periods stretch longer. At the same time, sovereign credit default swap spreads edge higher, despite Canada's strong credit rating. This is not yet a crisis, but it is a foundation. The central bank watches system liquidity closely, as commercial banks hold more reserves and lend more cautiously. Money moves more slowly through the economy. People feel this. Directly, mortgages become harder to obtain. Credit cards grow more expensive. And every spending decision carries psychological weight. When small signals align, the question is no longer whether a crisis exists, but where the economy stands within the cycle. Asterisk. To understand what the Bank of Canada fears most, one must understand how modern economic shocks operate. Unlike classic banking collapses, today's shocks often begin with expectations. When businesses believe demand will weaken, they delay investment. When households believe home prices will no longer rise, they stop borrowing. This chain reaction weakens demand, reduces income, and feeds back into debt pressure. Interest rates, the primary policy tool, become a double sword. Keep them high to fight inflation, and credit is suffocated. Lower them to support growth, and the currency comes under pressure. In an open economy like Canada's, even small shifts in the interest rate gap with the United States can trigger rapid currency depreciation, pushing import costs and inflation higher. The central bank knows the most dangerous shock is not a single event, but the accumulation of small forces over time, slowly eroding confidence in economic control. Global economic history serves as the largest laboratory for central bank fear. In 1997, the Asian financial crisis erupted when economies that appeared stable ran out of reserves to defend their currencies. The IMF stepped in with rescue packages, but at the cost of deep recessions and lasting social scars. Argentina offers repeated lessons in debt cycles, inflation, and currency collapse. Greece, after 2009, became a case study in sovereign debt within a constrained monetary union. Turkey and Venezuela show what happens when central bank independence is lost, interest rates politicized, currencies collapsing, inflation devouring daily life. Canada is not these countries, but the lessons remain timeless. Crises begin when policy credibility fades, and they end long after the numbers stabilize. Comparing Canada to extreme cases is not meant to spread fear, but to define safe boundaries. Canada has a floating currency, a tightly regulated banking system, and the ability to borrow in its own currency. Yet it is not immune to global pressure. When the US Federal Reserve keeps rates higher for longer, Canada must consider following to prevent capital outflows. When global supply chains fracture, the exchange rate becomes a channel for inflation. The Bank of Canada fears being trapped between two goals: weak growth and persistent inflation. In such an environment, every basis point decision is not just technical, it is a signal to global markets. If that signal lacks clarity, volatility fills the gap. People experience the consequences in concrete ways: rising rents, higher food prices, and wages that fail to keep up. Ultimately, the central bank's fears are reflected on the dinner tables of ordinary households. The impact on Canada's economy is uneven, and this imbalance is precisely what worries the Bank of Canada. The financial sector may appear stable, while households face growing strain. Debt service ratios rise sharply as mortgages renew at rates far higher than those of 2020 to 2021. Small businesses, reliant on short-term credit, confront higher capital costs as consumer demand softens. The labor market still looks resilient on the surface, but real wage growth weakens, signaling declining purchasing power. In this environment, liquidity becomes the key word. When cash flow slows, even minor shocks can spread. The central bank fears a familiar historical pattern, not an immediate collapse, but a prolonged fatigue long enough to drain confidence and turn every policy choice into a harder one. Government and central bank responses are constrained by invisible limits. Fiscal policy can offer temporary relief through spending or subsidies, but rising public debt becomes a long-term burden. The central bank, independent in theory, faces social pressure when high interest rates directly affect millions of mortgage holders. What it fears most is the loss of policy credibility. If markets believe inflation will not be contained, expectations become self-fulfilling. Inflation stops being a statistic and becomes behavior people buy earlier. Businesses raise prices defensively, and the spiral begins. Canada has avoided this scenario for decades, but credibility is not permanent. It must be maintained through difficult decisions, often unpopular, but necessary to preserve long-term stability. One of the Bank of Canada's quietest fears lies in the housing market, where financial risk meets social psychology. Home prices are not just assets, they underpin consumption, credit creation, and middle-class security. When prices rise too fast, household debt swells. When prices stall or fall, the wealth effect reverses. Spending tightens, banks restrict credit, and a downward loop forms. The central bank monitors loan-to-value ratios, mortgage terms, and household interest sensitivity. A sharp correction would affect not only GDP, but social confidence itself. Canada has never experienced a housing collapse like the US in 2008, and precisely because of that, collective memory offers little psychological immunity. The fear is not correction, is panic if correction arrives too quickly. Another transmission channel that keeps the Bank of Canada vigilant is the exchange rate. The Canadian dollar is often viewed as stable, but stability does not mean immobility. When interest rate differentials widen, capital seeks higher yields elsewhere. If the dollar depreciates rapidly, imported inflation returns, especially for energy, food, and essential goods. The central bank understands that the exchange rate is not an abstract number. It is the cost of daily life. Gasoline prices rise, grocery bills climb, and inflation expectations reignite. In a worst-case scenario, the bank must keep rates higher than desired to defend the currency, even as domestic growth weakens. This dilemma has haunted many emerging economies and is exactly what Canada seeks to avoid. System liquidity is the bloodstream of the economy, and this is where the Bank of Canada watches most closely. When commercial banks grow cautious, they hold more cash, reduce long-term lending, and prioritize balance sheet safety. This does not cause immediate collapse, but it slows economic motion. Businesses delay expansion, households reduce spending, and growth becomes fragile. History shows that crises often begin when liquidity evaporates suddenly, as in 2008, but there is another danger: liquidity that exists only for a few. The Bank of Canada fears a scenario where small businesses and households are pushed out of credit markets, while large institutions retain access. Prolonged imbalance of this kind can damage social structure more deeply than any recession statistic.